Well, hello, everybody. Today is September 22nd. It's about 3 o'clock p.m. And today's market update, I have just a couple things. I'm twisting it up a little bit. I'm tired of showing exclusively charts in my videos, so I thought I'd make this snazzy cover here. And then also go over just a couple little bits of latest news. So for those who've been paying attention, the last couple days have been really bad in the world of the stock market, not just here in the United States, but really everywhere in the entire global financial system. And part of the reason why, the markets have been volatile in general for 2 months, and I think a lot of people were waiting to see what the Federal Reserve would do. There was a Federal Open Market Committee yesterday, actually the last 2 days. It was a 2-day event. And at the conclusion, what the Fed announced was something called Operation Twist. And to be honest, I'm not sure if it's a name they came up with or just what the media is calling it, but that's what you'll hear about in the news is Operation Twist. And for those who are wondering what Operation Twist is, basically the Federal Reserve has a balance sheet of Treasury bills, U.S. government bonds, basically, or government debt. And right now, a big chunk of that debt is short-term, and what the Fed's planning on doing is selling the short-term debt and then using the proceeds to buy long-term debt. The idea is by buying long-term bonds, 30-year treasuries, it will drive down the yields. So in other words, whenever there's more demand for something, it's going to create a bunch of people buying an asset. When the asset's bought, it drives the price up. And in the world of bonds, when the prices go up, the yield or the interest that's paid goes down. So when we have Operation Twist happening, is we're going to see shorter term rates perhaps come up slightly, and then longer term rates go down slightly. And I'm not sure exactly why that's supposed to be a great thing, considering long-term rates are as low as they've been in my lifetime, and frankly, I think in the lifetimes of most people who will be watching this video or even alive today. But I think the concept is if they can keep rates lower, if they keep rates as low as possible, it may spur some economic activity. So, for example, if mortgage rates, which already are incredibly low, drop another 2 or 0.3%, I suppose that'll help free up a little additional cash flow for the average American who has a mortgage. And with that extra cash flow, they'll spend some money, and that may spur the economy. That's the thinking there. But what I think this is too, the analogy I like to use in this is it kind of reminds me of, there's people who get these letters in the mail. I know I get them all the time from virtually every credit card company, and they'll have a check or something attached to them, and the check will say, use this check for the next 12 months or 18 months, you'll get a loan, basically, you'll get, some cash, and we're only going to charge you, 0% or 1% or some really nominal rate. And of course, you have to pay that off at some point, whatever that time period is, 12 months or 18 months. So let's say somebody gets those in the mail, and they decide to go ahead and take that offer, and then they turn around and they buy some long-term bonds with that. I think, again, the idea here is the Fed's creating a bit of an arbitrage. They're not changing their balance sheet. In other words, the amount of debt's not changing, or the amount of the bonds is not changing. It's just the term of the bonds. And so the bonds they're buying are going to be paying slightly more interest in the bonds that they're selling, and it will, again, slightly lower the interest rate on those long-term bonds. Well, again, if we take my example, here of someone who's taking money at these low rates and then buying at longer rates, perhaps in the short run that works out well. But eventually you have to pay back that money. And if the interest rates are substantially higher in 12 months or 18 months or 2 years or whenever someone keeps doing that, it'll end up hurting them a lot more in the long run than it helps in the short run. And I think that's kind of what's happening here. We, as a country, we already have a substantial amount of debt in the United States, and having more long-term debt versus short-term debt isn't necessarily better. It's just debt, all one and the same. and eventually it has to be repaid. And what will happen is if the Federal Reserve has a bunch of 30-year bonds paying 3.5 or 3.7 or some nominal rate, but eventually rates start getting substantially higher, they're going to find themselves in a pinch. In other words, their move, their twist will backfire. And I think the short-term benefit is not nearly what the market was looking for. So I think what a lot of investors were really hoping for is that the Fed would do something not unlike they did a couple of years ago, or over the last really 3 years with quantitative easing, essentially inserting a bunch of additional money supply, whereas right now they're not necessarily increasing money supply, they're just taking the dollars that we have or the debts that we have and they're making them long-term versus short-term. So that's kind of what Operation Twist is. If you hear that in the news, that's what it's all about. And the reaction from the market was very negative. Again, I think the expectation was something a lot more stimulating than just transferring short-term interest rates up and long-term interest rates down. As a result, stock market has sold off pretty severely. In the last 2 days, we've seen about a 6.5% decline in U.S. stocks, and even a much more significant number in a lot of foreign stocks. I just saw today that the Chinese market is now down 30% from its high this year. So when we're looking at places to invest, I think it's kind of in vogue. People might say that the foreign stocks are better than the U.S. stocks. The reality is this year that's not been the case. It's been the exact opposite. If we look at foreign markets as a whole, not just China, you can see I have a note here that many are down 20 to 25% for the year. And now most stock markets are negative for the trailing 1 year. And again, foreign markets are down significantly, many 15% or greater over the past 12 months. So that's kind of what's happened, lately here these last couple days. Now, y'all may remember I posted just 2 days ago, actually right before this big crash, that our economic indicator had signaled the worst decline in the economy in the United States that we've seen in the last few years. So, I suppose it was fairly timely, but at the end of the day, the market's moving so quickly that even having that type of information doesn't necessarily guarantee someone's going to get out of harm's way in entirety. Now, good news for our clients, for those who are clients watching this video, I just took a look at our moderate allocations, which is sort of like our middle-of-the-road balanced portfolio, and it's the most common used by our clients. And the portfolio right now, the top 10 holdings, which make up 69% of the portfolio, are actually all up for the day. So the majority of our portfolios are actually rising on the day, but we do obviously have 30% or thereabouts that are falling right along with the market. So the end result might be a small loss, but certainly not to the tune of the 400 plus point drop in the Dow. But that's kind of what's happening when we look at, again, what our indicators tell us. It does help us move away from some of the harm of the market, but not in entirety all at once. So that's kind of what's happening there. I'm going to move off this and go back over to my typical kind of chart view here, and see if I can shrink this down so it's easily seen. All right, so this is a chart I've shown quite a bit in the last couple of weeks, last few weeks really. The reason I've shown this is that it was a very basic kind of model that tracks long-term momentum, and I mentioned a couple weeks ago that because of a rally that we'd had, in fact it was just last week, it looked like there may be a chance that by the end of the month, this model would say, hey, the market, while being sold off, is not to the point where people should react. Well, that's all changed, and I even made a comment in one of the videos that I wouldn't be shocked for the market to decline this week, because what's been happening the past 4 or 5 weeks is there'll be a great week followed by a bad week. So the market's just trading in this range where it's not necessarily going anywhere, just going up and then down. It makes it very difficult for anybody to psychologically stay committed to their investment plan. But again, what we're finding is that while there's still 6 business days left in the month, if the market was to finish here, it would be very, very bearish. And the numbers I was watching, I said, boy, the market needs to sustain staying above 1,200. And it had been doing that up until yesterday. And right now, as I'm recording this, I'll just update this this chart to get the exact number here. It's at 1122.36, which is just about the lowest point we've seen in the entire year. Some other interesting tidbits about this, I'll just kind of highlight some things, kind of where we are today. Here's some points in history we're at this same level. So most recently, we were here obviously last summer or last fall. We were also here last spring. We were also here in October of 2009. We were also at this same level in July of 2004, as well as April, kind of the spring and summer of 2002, as well as April of 2008. So 13 years, there's been a number of times the market's been at the same level, but essentially no gains, just big rallies, followed by large declines, followed by big rallies and large declines, and so forth. So when we look at where things are today, it's hard to make the prediction that the markets will just magically start going up. It seems to be that we're in this range, and it's not unlike what the Japanese have experienced for the last 25 years, where there's really been no increase in their stock market, just a series of rallies followed by declines. And in this type of a market, a buy and hold type of strategy does not work very well. Now, there's no exact science in timing when to be in or out of the market, but by all indications, the type of market conditions we've been in, these highly volatile markets that over time have not produced any results for investors, it is smart to have a series of exit strategies, ways to try to get out of the nastiest of the declines. So we'll see what happens these next 6 days, and as I always mention, I'll keep everybody updated. But certainly in our portfolios, if you look at some of the previous posts on the blog, you'll see that a number of our portfolios went very heavy to cash at the end of August, so they haven't experienced much at all of these big declines in September. And I think a number of things that we do are going to change in September so that they'll be even further defensive come October and into the future beyond that. And again, I don't know exactly what will happen. I can just tell everyone that if the market falls below 1100, it probably will go to 1050. And if it goes below 1050, I would watch out, because I think the market could drop another 20 or 30% from there. So that's why in our case, we have these, rather defensive portfolios without a whole lot of exposure to stocks. Doesn't mean that the past 6 months have been glorious, but it does mean that we're preparing for what may happen in the next 6 months, 12 months, and beyond. And I'm not sure that the Fed is going to be able to do a whole lot because there's so much resistance politically between the two parties. And if we don't have any intervention, I think that's actually the best long-term scenario, but it can also create a lot of short-term volatility. So my analogy that I steal from Peter Schiff, who I think has some very good points on this, when we have a lot of government intervention, it can sometimes create short-term rallies like what we've seen in the past 2 years, but it's kind of like throwing fuel on the fire. You don't actually put the fire out, you just make it worse. So when the day of reckoning comes, it becomes more painful than it was before. So we have to be careful about what we wish for. We don't want more intervention. What we really want is less, because in the long run, that'll make the free markets work a lot better. In other words, it'll let capitalism sort of do what it's supposed to do and not let the government continue to influence the type of moves that we've seen in the market. So that's the update for today, probably my last one for the week, even though today is only Thursday. Hope everybody has a great weekend. And of course, I'll be back next week, perhaps 1 or 2 video updates. And especially at the end of the month, we'll do kind of a month-end written commentary and give everybody some really good ideas as to what we're looking at for October. September so far is shaping up to be even worse than August. So the last 2 months, not good at all. But October historically has had a couple pretty nasty months. So it's not from a seasonal standpoint, not a typically strong month for markets. And there's not a whole lot of great news looking like it may come on the horizon. About the only real catalyst to make the markets go up from here would be some type of intervention that, again, may have some short-term impact, but may just make the fire bigger in the long run. So that's it for today. Thanks a lot for checking out this video, and I will be back in touch next week.